Hello, my name is Chad Taylor, Managing Partner with MDT Financial Advisors here in Houston, Texas. Today I wanted to record a video on kind of our MDT Markets Minute. I was recently reading some reports coming out of the Wells Fargo Investment Institute, and I thought it was interesting, so I just kind of wanted to share some of the concepts that I was reading about. So here's a strange thing about the stock market. A company can report record profits, their best quarter ever, and then the stock can drop 8% the next morning. How does that make any sense? Corporate company earnings were better. Why is the stock dropping? And that's exactly what I want to talk about today, because we just have recently kicked off the second quarter earnings season. And this dynamic, where good news isn't good enough, is going to drive a lot of the headlines you'll see over the next few weeks, or could drive a lot of the headlines. So stick with me here for a few minutes and I'll explain kind of what's going on, what we're watching, and most importantly, what it means for you at this kind of stage of the game and timing. So let's set the stage. Every 3 months, publicly traded companies open their books and tell the world how they did. That's earnings season. And this quarter, Wall Street is expecting big things. Analysts think the S&P 500 companies grew their profits about 24% roughly compared to a year ago. And so let me put that in perspective. That's the kind of growth you normally see only when the economy is bouncing back from a recession, which we haven't had a recession. And at this point, we're not coming out of recession. And this is just expectations running hot, largely because of the excitement and spending around artificial intelligence. And here's the part that's kind of unusual right now. Analysts have been raising their estimates all quarter. Normally they hedge and trim as the quarter goes on, but not this time. Now you might think, great, strong profits, rising expectations, that should be good for the stock market, right? Or good for me if you're in the stock market. Well, here's where it gets a little interesting. So let me kind of give you an analogy. Think about like a high jump, in track and field. If the bar is set at 4 feet and you clear 5 feet, everybody cheers. You went higher than the bar. But if the bar is set at 6 feet and you clear 5 feet, same jump, same height, you get a totally different reaction though. You failed, even though you jumped just as high. That's what the market's doing right now. The bar is set very high, very high. And it's actually worse than that because there are really two bars. There's the official one, the published analyst estimates. You can see that all the time. And then there's an unofficial one that professional investors trade on, sometimes called the whisper number. And that's the number the big institutions actually expect after they've talked to management, checked supply chains, and read the tea leaves. It's a little like a kid who brings home an A on a report card, but the parents were expecting an A+. Technically great, still a disappointed dinner table. So this earnings season, a company can beat their official estimates and still get punished by the market because it didn't clear the second higher bar. Good results may not be good enough. So what are we paying attention to? Two things. First, technology companies, specifically those spending specifically AI spending. Some of these big tech names are priced as if the good times will continue to roll indefinitely. And so far, they really have delivered. But the market isn't going to look at the profits. It's going to look at how much these companies are spending on AI and whether that spending is actually starting to pay off. If there's any hint that the AI money isn't producing return or the demand is cooling, that could actually trigger some selling, even if the actual earnings numbers look fine on paper. And then second, banks and financial companies. They report first, and they kind of set the tone for the earnings season. In our view, or in the view of this report, they've actually in a pretty supportive spot right now. Loan growth looks healthy, deal activity is picking up, and people are paying their bills on time. Delinquencies and defaults are near the lows of this cycle. So we expect technology and financials to to maybe do okay this quarter. Doesn't mean that they will, but that's what we're looking at. And this question isn't whether the results are good. The question is whether they're good enough for the market that's already priced for great. Okay, so what do you do with all this information in right now in your portfolio or just your thinking? Three things really. One, expect some bumpiness. With expectations this high, there's not much room for error. Companies that miss even by a little could get beat up here or get punished here. And you'll see some scary red days in the headline. More than likely, it's not a crisis. It's just reacting to this phenomenon. Okay. Number two, don't confuse a stock dropping with a company failing. Remember that high jump illustration. A stock falling after earnings often means expectations were too hot, not that the business is broken. Okay, and then three, volatility can be your friend, as tough as that is sometimes. Our overall outlook on the economy, and really from this report, reading from that I was talking about, is that the economy and earnings remain positive. Okay, I'm always fairly cautiously optimistic, but over time, or short term, that's what this report was mentioning. So when quality companies in a sector that we like get knocked down simply because they only cleared 5 feet when everyone expected 6, that could create an opportunity to invest in some of those companies. Not a reason to panic. Okay. So, as always, the right move for you depends on your plan, your timeline, your income needs. And that's more of a conversation, not really a headline like we're talking about here. So, here's the bottom line: profits are growing strongly, expectations are growing maybe even faster. In the next few weeks, we're going to have a tug of war between those two. So, don't let the headlines rattle you. And most of what you'll see is just the market kind of recalibrating a very high bar, right? So if you have questions about this or anything else, please don't hesitate to reach out. We always look forward to talking. Thanks and have a great day.